Good morning. I am Jordan Weaver, a fourth-year accounting student from Fort Lauderdale, Florida.
Good morning, I am Guy Mara Lavelle, a fourth-year accounting student from West Palm Beach, Florida.
Hello, I am Kyle Hepburn, a senior accounting major from Freeport, Grand Bahama, Bahamas.
And I am Olarinwaju Yenuge, a fourth-year accounting student from West Africa, Nigeria. Today, we will be discussing the audit on EOG resources. Introduction. Our group has conducted an audit on EOG resources in accordance with the accounting standard. Our audit procedure includes the examination of the financial statement, evidence supporting the amount and disclosure in the financial statement, also assessing the account principles used and scenario estimate made by the management, and evaluating the overall financial statement presentation. We believe that our audit provides a reasonable basis for our opinion. Right here is the EOG internal business process. Firstly, EOG started their business process with upstream. What is upstream? Upstream is commonly referred to as the searching, recovery, and exploration and production of crude oil and natural gases. And from there it goes to exploration. From exploration it goes to development. From development it goes to exportation. From exportation it goes down to mining. From mining it goes to marketing. From marketing it goes down to downstream. I come again with downstream. What is downstream? Downstream is referred to as the refinery of crude oil and selling and production of natural gas and products derived from crude oil, such as liquefied petroleum gas and gasoline. Now, it's my pleasure to introduce my colleague, Gamara.
Good morning again, I am Guy Mara Lavelle, and my part is the attribute and inherent risk. Inherent risk is basically the measure of the auditor's assessment of the likelihood that there are material misstatement in the segment before considering the effectiveness of the internal control. And therefore the residual risk would be then after they consider the internal controls, whatever risk is left over would be the residual risk. And then in the cash and cash equivalent segment, you must review all the cash and cash equivalent transactions. Even though the company does not have a lot of cash transactions, but they do have a number of cash equivalent accounts. So those must be reviewed thoroughly and assessed thoroughly. And then it comes to inventories. They don't have like not necessarily office supplies or like cans of food, but they have oil. And most auditors are not able or capable of testing the oil. So they must either hire an expert who would be able to identify the oil and assess that it is legit, or they can hire a third party, which is an expert, to do the same thing. And then back to the residuals, which is the risk after the controls are taken into account, or it could be the net risk, basically. And the oil gas exploration cost specific audit program is used on the test of existence. Again, we're back to existence of the legitimate, whether the oil is legit and sellable. Capitalized interest is basically an account that firms usually set aside to accumulate throughout the year for interest expenses. So it's basically a prepaid expense account. And capitalized interest allows a company to spread out its tax deductions as opposed to earning a business expense deduction for only a single year. And now I will introduce to you Cal, who will go into rational and for entity level control.
Hello, first I want to talk about cash and cash equivalents. When conducting this audit for EOG resources, we were intuitive to a few accounts that caught our attention. As we conducted our audit, we reviewed all cash and cash equivalents with original maturities of 3 months or less. We also compared the balance of cash and cash equivalents with previous and forecasted estimates. We concluded that the risk of materiality is high and can be mitigated by controlling cash through account reconciliation. Accounts receivable and income tax receivable. Coming into the audit, we had a professional skepticism about the account being high in the material misstatements. We conducted that control activity is the best way to mitigate account reconciliation. Here, we also noticed that these accounts has a tremendous direct effect on the balance sheet. My second slide, I want to again talk about cash and cash equivalent, which is the best control for control activities. A reassessment of cash balance involved a detailed review of cash flows is performed to understand EOG resources, business and operating activities. Now I want to talk to you about accounts receivable and income tax receivable. Reassessment of the reconciliation account required control activities which in part suffice to establish a fact about the testing. Lastly, I want to talk to you now about inventories, which is a material weakness because the deficiency is important enough to attract attention by those which oversight the financial reporting of EOG resources. When we analyze the item, we notice that the best control to use is control activities. Inventory has a direct impact on the output and revenue of the company, so monitoring is insufficient to mitigate this risk of inventory. Like my colleague Amara stated, hiring a professional to analyze the inventory to measure the amount of oil being accumulated and transported is a great way to mitigate risk. Now I want to introduce my other colleague, Mrs. Jordan Weaver. Thank you.
Alright, now I will be telling y'all about the determination of control deficiency. First, we have a lot of those, but we picked out 3 major topics. The first one being transportation, cost of goods sold, accrued expense, and other accruals. With these accounts, we believe that it is material with weaknesses because the deficiency constitutes a material misstatement of the annual financial statements not being detected on a timely basis. And then you got the Alright, and then for the lack of effective internal controls, we believe that possibility of human error, circumference of controls overriding controls, changing in future internal controls over financial reporting, the loss of any members of the management team, and ability to attract, motive, and retain substitute management personnel with comparable experiences and skills. Now I'll be passing the floor back to Larry.
Well, we would like to use the opportunity on behalf of myself, my colleagues, my teammate, the Sunshine team. We would like to say a big thank you to Dr. Hill. She has been a wonderful professor, showing us every step along the way how we can be a successful accountant. And also, even though we know that this project is very, very stressful and tedious, but we do appreciate it because we learned a lot from it. And I believe my other members, they have something to say as well.
Lastly, I want to thank Dr. Hill for being a tremendous professor and teaching me about the audit. It's been a wonderful experience, and I just want to say thank you.
Alright, again, I would like to say thank you as well. You know, as my colleagues have said, Larry, he has said that it's been a stressful time and coming up with the audit risk. But we know, as it's been a stressful time, we have seen what auditors have to go through, and we kind of more understanding and have a better respect and understanding for auditors and their job. And we want to say thank you very much again for the semester and our learnings and our teaching and everything that you have taught us. Thank you.
Hello, Dr. Hill. I would like to thank you myself, not for just teaching me things in the classroom, but more life lessons that I would take with me in the corporate and when I do start my own firm myself. So thank you for everything you've taught me inside and outside of the classroom. And this concludes our presentation.
And we are.
We all just want to say thank you, Dr. Hill.
Thank you.
And we are.
Team
Sunshine.